Good afternoon. Welcome to our webinar on Do You Fully Understand Your Exit Options? What we're going to cover is just a very short introduction to strategic corporate finance to explain who we are, what we do, why we're qualified to talk about exit options. And then we're going to talk about, give an overview to exit options, and then compare a trade sale to a management buyout. And then a bit at the end about how we can help, and then we'll take questions at the end. Please ask questions anytime during the webinar. There's a Q&A facility that could be at the top or bottom of your screen, depending on how you're viewing this webinar. If you ask questions, just type in your question and we'll pick up on the questions at the end of the webinar. So just a bit about ourselves. We are specialist advisors that advise clients on transactional work, selling their businesses, buying businesses. Most of the work we do is acting for vendors, and often about half the time taking them through a trade sale process where we do detailed research to identify buyers, usually identifying buyers worldwide as well as in the UK, and take them through that process. Roughly half of our work is management buyouts, and often we act for vendors, sometimes for management teams or management buyouts. So we've done well over 100 transactions. We've been going 22 years, well over 100 transactions in the SME sector, typically clients turning over between 1 million and 15 million, cover most of the clients we act for. And therefore we've built up a wealth of experience on trade sales and a wealth of experience on management buyouts. So we're well placed to be able to advise clients on their exit options and which route is best for them. Our services principally include often quite a bit of early stage advice to make sure that the client embarks on a transaction that is feasible, that can be delivered. So we get involved on a regular basis in providing commercial valuations as to what a client can expect to receive when going through a trade sale process or through a management buyout. We do quite a lot of assessments of exit options, which can be things like a management buyout feasibility report to show what sort of value could be achieved, how much cash can be paid up front, how much on deferred terms, how it could be funded, what sort of equity stake the management team will be expected to put in, whether it's worth having retained equity and how that would work. So really giving clarity to a client on how a management buyout can be delivered and what it would look like, as well as the same for trade sales. With a trade sale process, we do a lot of research using quite expensive subscription databases that allow us to identify potential clients that are right for the business and identify potential buyers that are right for the business and identify international buyers as much as UK buyers. And our main services after the early stage advice is things like the buyer research, but it's lead deal advisory, seeing a client through the transaction, whether that's a management buyout, trade sale, helping through the process and helping deliver the process and getting it over the line at the end of the day. There's some examples there of trade sales and a few corporate acquisitions on that slide. The same images appear on our website and are clickable. So if you want to know about any of those particular deals, go to the website, find the same photo, and it'll tell you all about them. So that is trade sales and trade acquisitions, corporate acquisitions, and a similar number of management buyouts, buy-ins. And again, the same photos are on the website and are clickable. So at that stage, I'm going to hand over to Greg, who's going to take us through most of the rest of the webinar. And then I'll come back to talk a bit about how we can help at the end and to contribute towards answering questions that are asked.
Thanks, Andrew, for that introduction. So as Andrew's mentioned, I'm going to talk through a couple of things. So first of all, give an overview of the different exit options available, and then move on to talk about trade sales and management buyouts in a bit more detail and compare and contrast the two. So on this slide, I've noted half a dozen of the most common exit options for business owners, and I'll talk a bit more about each of these in a moment. But taking each one in turn, you've got the trade sale, which is often the first sort of option business owners think of when they're starting to think about selling their business. You've also got the management buyouts, which Andrew mentioned. We also do lots of in the course of our day-to-day advisory work. Most of our work will either be management buyouts or trade sales, but those aren't the only two options. You've also got the institutional buyouts, which is a sale of a controlling shareholding to a private equity fund. The management buy-in, which is different to the management buyout, in that you've got managers joining the business who didn't previously work in that business, taking a controlling shareholding and taking over the running of that business. And also the employee buyouts, which again differs from the management buyouts, in that the employees of the business, not just the management team, have an ownership stake, and that could either be directly owning shares or indirectly, which is more common these days through an employee ownership trust. And the final option on this slide is winding up, which is much less common. I can't think of any examples of client work that we've undertaken over the years where winding up was the best option for our clients. But that's not to say that in some situations that could be the best option if there's genuinely no sort of viable future for that business, and it's possible to wind up and convert the asset value on the balance sheet into cash. But I'm not going to talk any more about winding up during this presentation, but over the next few slides, I'll just sort of comment a bit further about the five other options. So just looking at the trade sale, first of all, this is obviously the most sort of typical way of selling a business, and involves selling to another company, usually a company in the same sector, which can be a competitor, but quite often it can be just a business that is sort of involved in the same sector, but perhaps has a slightly different product or service offering, and therefore not a direct competitor, or maybe a company that's selling the same products and services, but just in a different geography, and therefore there's some business sense in combining the two businesses and expanding its territory. With a trade sale, one of the advantages for owners is that it can offer a clean break. Usually there's a handover period involved, which may be a few weeks or a few months, where the previous owners help with the transition periods and handing over sort of key customer and supplier relationships and dealing with the transition. And that's often something that business owners are keen to do. Once they've sold the business, they do want to have that clean break and be able to walk away. On the other hand, selling to another company can often lead to changes in the business, changes in the way things are done, how services are delivered to customers, changes to the organizational structure, or even just soft changes such as the company's ethos and culture can change over time if there's a change in ownership. And that's something that often our clients are concerned about, and I think that they understand that once they have sold a business, it's down to the buyer as to how they run it going forward, but that can be a concern. With the trade sale, in most cases, the majority of the sale proceeds would be paid over at completion. There might be a small element that is held over for say 12 months or 24 months, which might be linked to future performance, or it might not. But usually most of the money changes hands at the point the business is sold, and that's an advantage of the trade sale route. And another thing to think about with the trade sale is that the process that's involved with the trade sale can be a long process, and there's a degree of uncertainty over how it's going to pan out, especially if it's a smaller business or a business that has certain commercial risks that might be difficult for a trade buyer to get comfortable with. So there's no guarantee at the end of that process. You will find a trade buyer willing to make an offer that meets the owner's expectations, and very often trade sale processes don't end successfully, and the business isn't sold. So it is important to take advice at an early stage before business owners take that decision to place their company on the market, to make sure that their expectations are reasonable, and it is it is the best option, and it's worthwhile going down that route. The second option is the management buyout. So this obviously is a sale to a company's management team. And one of the attractions for business owners with the management buyout is that there's an opportunity to shape the deal in a way that the business owners don't walk away immediately following a sale, and continue to be involved in some way with the business going forward. That could be continuing to work in the business day to day, or stepping down into a part-time role or a non-executive role, or sort of becoming the chairperson in the business, and mentoring the management team over the next few years following the buyout. And that's something that appeals to many business owners. Quite often the business has been their life, and the thought of just simply walking away after it's sold is a scary one. So that is one of the key reasons why business owners elect to go down the management buyout route. In contrast with the trade sale, in most cases a management buyout is business as usual. There's no major changes in the way the business operates or its culture, and therefore it's again something that appeals to business owners' sense of legacy, that what they've created will continue in the future, operating the same way, and isn't going to be sort of absorbed into a larger company. A very significant difference with the management buyout compared to the trade sale route is that usually there's a significant amount of deferred consideration. So some money will change hands at the point the company is sold, but a large proportion of the proceeds are normally paid on deferred terms to the previous owners, and usually that's over a period of several years. The amounts really sort of depend on the nature of the business, and how much funding can be obtained from banks or other funders. So it will depend on the circumstances, but in most cases that there is a large sort of funding gap that is usually filled by the vendors being paid out over a number of years. So if it's a situation where business owners need to kind of realize cash for their shares as quickly as possible, then a trade sale route might be the best option rather than the management buyout. Another important feature of management buyouts is that the process compared to a trade sale can be a lot easier to control and predict. So if you've got a management team in place that wish to buy the business, then you're already halfway there. You've kind of found your buyer. There's no need to kind of go out into the market and look for a buyer. It's usually possible to agree a deal fairly quickly at the early stages of a process, and again, provided that advice is taken at the outset, you can have a high degree of confidence that the funding that's needed to make the buyout happen can be obtained, and then it's just a process of actually going about getting that funding and then going through the legal process. The third option is the institutional buyout, which is a sale of a controlling shareholding to a private equity fund. This is more of an option for larger businesses that have good quantifiable growth prospects. It's either an option for the owners to de-risk. So it might be a situation where the owners are involved in managing the business day to day, but and have no particular desire to retire from a business. They may be young, but there's an opportunity to sell a controlling shareholding to a private equity fund to realize a cash sum to de-risk the owner's sort of personal financial situation, but then reinvest some of the proceeds into equity and continue to work in the business going forward, and work in partnership with a private equity owner with a view to a further sale of the business, maybe in sort of 5 years' time. On the other hand, it could be a situation where the company already has a strong management team, and the owners are in a position where they can step out of the business and have that sort of clean break from it, and allow the management team to obtain a minority equity stake in the business at the same time that the private equity fund acquires a majority stake, and allow the management team and private equity to work together to grow the business going forward. In terms of process, it is more similar to a trade sale compared to a management buyout, in that there's a need to draw up a prospectus or business plan for the business, and approach potential buyers in private equity funds, and look to solicit offers for the company. So again, there's more uncertainty involved in terms of what sort of offers will be forthcoming compared to a management buyout. But again, early advice is the order of the day, to sort of find out whether the institutional buyout route is a viable one for your business. The next option is the management buy-in. As I mentioned, so this differs from the management buyout in that it's a sale to an incoming management team who previously had no connection with the business. Similar to a trade sale, this can generate an opportunity for a clean break for the business owners after a short handover period. Normally, the incoming managers will want to sort of get to grips very quickly with the day-to-day running of the business, and will usually want to kind of limit the handover period to as short a period as possible. The management buy-in usually ends up sort of giving a business more impetus, and can be a good way of helping businesses move forward. And I've worked on a few management buy-in transactions over the years where this has happened, where you've got perhaps a business owner who's sort of looking towards their retirement and hasn't been focused on growing the business leading up to that point. They've sold to a younger manager or management team who's perhaps come from a corporate background, and then has sort of implemented a growth strategy and sort of helped the business grow very quickly after taking over. The way management buy-in transactions are funded is very similar to how management buyouts are funded. So you're relying on the cash flows and assets in the company itself to provide the funding for the deal. And very often there's also a large element of deferred consideration involved in the funding structure. So for that reason, again, it's if business owners are looking for 100% cash at completion for their shares, then a management buy-in is unlikely to be the best option. And also it's important that business owners get to know and get to trust the incoming management team and are confident that they will be successful in not only maintaining the profitability of the business, but also improving it, and that that they're worth backing by receiving some of their sale proceeds on deferred terms in the future. The management buy-in option can be a very good option where you've got smaller businesses that don't have an incumbent management team with the ambition or the capability to take over from the business owners, and these sort of subscale businesses, we call them, are often less attractive to trade buyers because they are smaller and they don't have that in-house sort of management team that a trade buyer can work with. So for smaller businesses, the management buy-in route is worth looking at. And the final sort of option I'm going to run through quickly is the employee buyouts, where the employees of a business take a controlling shareholding in their employer. And these days, this is usually done via an employee ownership trust. So the employees wouldn't directly own shares in the company. They would be the beneficiaries of a trust that would hold the shares on behalf of the employees collectively. There's some very sort of valuable tax benefits associated with a sale of a business to an employee ownership trust. For vendors, this is notably an exemption from capital gains tax. So the gain made on selling their shares to an employee ownership trust is tax-free. And there's also some valuable tax benefits for the company and employees. So an employee buyout is typically funded by contributions from the company to the employee benefit trust, which are then used to pay out the former owners. Contributions to the employee benefit trust are tax deductible, so there's a corporation tax saving there, and employees can benefit from small bonuses from the company, tax-free as well. So tax is one sort of attractive sort of reason to look at an employee buyout. Like a management buyout, the deal would be funded by the company itself, and very often with employee buyouts, maybe if there's some surplus cash in the business, that would be immediately transferred to the employee benefit trust and used to pay out to the former shareholders on day one. But the rest of the consideration would be paid on deferred terms once the company generates the profits and cash flows necessary to sort of fund the employee benefit trust and pay out the former shareholders. So owners need to be comfortable that with this option, they'll have to be patient and wait for several years before the company has generated enough cash in order to fund the transaction in full. With an employee buyout, comparing that to a management buyout, there is a risk that the managers in the business won't be sufficiently incentivized in the same way that they would be with the management buyouts, where they are owners of the business. So there needs to be a clear plan for how the business is going to be managed going forward if it is owned by an employee benefit trust. And also owners need to think about how they reward the employees that have worked with them for many years. So it might be the case that they're attracted to an employee buyout because of the idea of repaying the loyalty of long-serving staff. But because of the way employee buyouts are funded, it will probably be several years until all of the sort of the proceeds due to the former shareholders are paid off, and by that time some of the longer serving older employees might have also retired and left the business, and therefore wouldn't benefit as much from an employee buyout than younger employees or employees who will join in the future. So that's a brief overview of the different options for business owners when they're coming to exit. And I'm going to move on and just compare the two most common exit routes, being the trade sale and management buyout. So I'll look at the valuation that can be achieved with both those options, the process that's involved, the impact on the business in terms of continuity, how they're funded, and also issues relating to the confidentiality of those two types of transactions. So first of all, what valuation can you expect to achieve from a trade sale compared to a management buyout? The common perception out there is that a trade sale will deliver a higher valuation than a management buyout. And it's understandable why people would sort of assume that, because trade buyers will have their own funds to put towards making acquisitions, whereas the managers of a business tend not to have much of their own personal money to put into a deal. And also trade buyers might be able to benefit from efficiencies and cross-selling opportunities and the like, and therefore could improve the profitability of the company they're buying very quickly, and therefore ought to be able to pay a higher price. So while those things are true, it's not necessarily the case that trade buyers will place a higher valuation on a company. And that comes down to the balance of risks with these sort of transactions. With a trade buyer, they would be paying with their own money for the company. They're also an external party, so they don't really know as much about the company as an internal buyer, such as the management team working in a company. So they'll be a bit more skeptical about a business and be more sort of drawn to looking at the potential risks and what could go wrong with the deal. And also they tend to be more price sensitive. So part of what makes a successful acquisition for a trade buyer is buying at the right price. And also they can shop around and look at many different companies and find which one meets their requirements best, and which one that they can get for a good price. Whereas with a management buyout, because the deal is being funded by the company and its cash flows and assets rather than the managers, it means that managers can sort of take a bit more of a view on what the business is worth to them. So managers might only be contributing 10, 20, 30, 40, 50,000 pounds of their own money towards a management buyout, which is a lot of money to them, but in the context of the deal as a whole, it is a relatively small amount. And therefore the risk they're taking is the money that they're investing in themselves, rather than how much in total is being paid for the business. So what we find anyway is in the course of our work is that in many cases it's possible to structure a management buyout which has at least the same value as a trade sale, or if not more, because of how the deal's funded, because maybe most of the consideration is being paid on deferred terms. That's a risk for the the sellers of the business, and if they're happy with that risk and to have that money paid on deferred terms, then it makes sense for the management team to pay that valuation, provided that the amount of money they're contributing to the deal personally is kept to a fairly small amount. In terms of process, as I mentioned before, with the management buyouts, the parties to the deal are already known to each other, and therefore there's no sort of marketing process to go through, and you can kind of skip that stage that's needed with the trade sale to actually go out into the market and find a buyer. But that said, with the management buyouts, there is a fundraising process to go through, and how long or complicated that takes depends on the nature of the deal. But in most cases, there's at least a process of preparing a set of forecasts and a business plan to share with banks and funders, with the aim of securing some funding towards the deal. As I've mentioned before, with the trade sale, you never really know how much appetite is out there amongst trade buyers, how many offers you'll receive, and what the terms of those offers will be. So there's a bit of uncertainty around a trade sale process compared to a management buyout, where at a very early stage, both parties to the deal will know what the price is, what the terms are. Negotiations with a management buyout tend to be quite a bit easier compared to a trade sale, and that's because both parties know each other already. The management team already know about the business, and therefore, so long as both parties sort of are reasonable and sort of work in good faith with each other, it's usually sort of fairly sort of quick to arrive at the agreed terms for a deal. And the due diligence process again tends to be easier with a management buyout compared to a trade sale, for the reason that the management team already know about the business. Most of the due diligence work will probably be dictated by the funders participating in the deal, as a way of controlling their risk and making sure there's nothing untoward in the business that they haven't been told about. I've touched already on business continuity as an issue that business owners need to think about and often find important when deciding on the best exits option for them. A management buyout is often seen as the best option for this reason. If business owners are worried about what's going to happen to the business if it's sold to a third party. If it's a management buyout, that can usually be sort of presented in a very sort of positive light to other stakeholders in the business, that nothing's changing. It's the same people running the business. The same sort of levels of service will be delivered to customers going forward. There's not going to be any sort of major changes to the organizational structure, and everyone's jobs are safe. But that said, in some cases, a trade sale might be the best option, and being part of a larger group can be a positive impact on the business. So it might offer greater career opportunities for managers and employees to be part of a larger group, and also being part of a group may help the business move forward, and sort of changes can be a good thing. So I've touched a bit on funding of trade sales and management buyouts. With a trade buyer, again, it depends on the circumstances, but most trade buyers will be well funded already, and don't need to sort of go through a specific fundraising exercise in order to be able to complete an acquisition. Some do, and it's always worth investigating a trade buyer's funding position before agreeing terms with them, so that you understand if they are reliant on securing funding from a bank or other funder for a deal. As I've mentioned, most trade deals involve most of the consideration being paid at completion, whereas with the management buyout, the amount of money that's paid at completion depends on how much money can be raised from banks and other funders. The money that's invested by the managers themselves is relatively small in the context of the deal. It might only be enough to cover the sort of the deal costs involved with the transaction. So it depends on the nature of the business, how much money can be paid out at completion, but generally speaking, you may find that only half of the business's value is paid out in cash at completion, and then the rest would be paid on deferred terms over a number of years. But even though that is a downside to management buyouts, that there is a silver lining on offer, and that is that there's an opportunity for business owners to earn a good rate of return on the money that they've left invested in the business as deferred consideration. So, for instance, you could charge interest on that deferred consideration, and that can generate something much more income rather than having that money paid out at completion and then placed in a deposit account with the bank. And there's also an option which often we build into deals for our clients, is to retain a minority shareholding in the company rather than selling out 100%, and then there's an opportunity to benefit from the capital growth on that minority shareholding, and sort of benefits from what's usually a very sort of rapid increase in equity value that results from a management buyout. And I think this is the final point, but confidentiality is sometimes a factor that comes into the decision-making process as to whether to go down the MBO route or the trade sale route. There is a risk with trade sales that the process isn't kept confidential, and someone involved spreads industry gossip that a company is for sale, and that can be damaging commercially, and also upset staff within a business if they hear rumours that their employer is for sale. So contrast that with a management buyout, where it's possible to keep the transaction completely in-house. There's much less risk of any breach of confidentiality, and even if staff do sort of find out that a management buyout is taking place, there's much less risk of any sort of issues flowing from that, as it will be a positive thing that ownership succession is being dealt with, and there'll be no sort of change to how the company operates going forward after the management buyout. Also, with a trade sale, there can be an issue with sharing sensitive commercial information during a due diligence process with potentially a competitor, because if the deal did abort for any reason, then again there's potentially some commercial issues from having shared that information. So just to conclude then, the sort of situations that would be best suited to a trade sale as an exit option are situations where the owners are looking for a clean break and would like to exit from the business as soon as possible. The owners need to maximize the cash proceeds from selling their shares at completion, where the management team in the business don't have the aspiration to take the business forward, or the skills or expertise needed in the view of the business owners. Perhaps it's situations where there's a lot of deal activity in the sector, and there may be sort of one or more consolidators actively going around and buying up companies in a particular sector. And also trade sales, they're much easier to do where there's a business that doesn't have any major commercial risks. Every business will have commercial risks. It's just the degree. For instance, if it's a contracting business that is reliant on winning the next contract, and there's no sort of visibility over what work the business is going to be doing next year, that's a very high commercial risk, and one that's difficult for third-party buyers to get comfortable with. The sort of situations where management buyouts is maybe best suited. Perhaps it's situations where the owners, rather than looking for a clean exit and to sort of exit as soon as possible, where they like the idea of remaining with the business in some capacity going forward, maybe in a chairperson role, maybe with a retained minority shareholding. Situations where the owners have a good relationship with the management team have the skills and expertise and the ambition to sort of take the business forward, where the owners aren't looking to get every penny they can out of the deal on day one, and are willing to sort of leave some investment in the business going forward. And conversely, where there's some risks in the business that might otherwise put off trade buyers. So it could be contracting businesses, or businesses where there's a high degree of dependence on one or two key customers. So with the management buyouts, because the managers in the business already hold those relationships with those key customers, they're going to have a very sort of different view on the level of risk compared to a trade buyer, where they don't know those customers personally, and we'll see that as too great a risk for them to invest in. So just to conclude, there are different options. It's not just a case of a trade sale. It's also important to think about the management buyout route, and also other options such as private equity or employee ownership. Every company and situation is different, so it's impossible to say which is the best one. It depends on the nature of the business and the objectives of the shareholders. Although the focus tends to be on headline price and multiples and the sort of financial aspects of a deal, softer issues are also important to clients in our experience, such as what's the best thing for the company and the staff and the customers, and also whether they want to be involved in the business going forward, rather than just a clean break. And finally, just take advice, but be aware of biased valuations. So we do provide valuations for clients, but we always do those on a paid basis, rather than on a free basis, where we're just sort of looking to persuade business owners to go down a trade sale route. So we always look to give unbiased and honest valuations to clients. And I'll hand back over to Andrew at this point to sort of talk through how we can help in a bit more detail.
Thanks, Greg. Just before I go through how we can help, just to remind, if you want to, I think we've had 3 questions so far. If you want to ask a question, use the Q&A facility that's either at the top of the screen or bottom of the screen. Just type in your question. In about 2 minutes, we'll get onto questions and we'll answer all the questions we've had. So how we can help. I really covered quite a bit of this in the introduction. So I'm going to go through it fairly quickly. As I said in the introduction, we believe in giving upfront early stage advice to make sure what we embark on for a client can be delivered. So we like, it's essential before it's a big mindset change to decide to sell your business. And once you've taken that decision, embarked on it, it's a horrendous situation to find you can't achieve anything like the value you expected, or the deal doesn't happen, or there's issues where you can't sell it, or you've agreed a deal with a management team that can't be funded and the management team are now demotivated and leaving. So early stage advice to make sure you understand exactly what can be delivered, what value, how it can be structured, how it can be funded, what can be paid on day one, what would need to be paid on deferred terms. Giving you clarity is absolutely essential before you take the decision to embark on one process or another. You need to know where it's going to lead and have a really good understanding of where it's going to lead and look like. So we do evaluations, we do trade sale feasibility reviews where we'll look at deal activity in the sector. We'll look at deal activity not just in the UK, but internationally. We'll identify issues that are likely to make the business difficult to sell through a trade sale and discuss those. And we do MBO feasibility reviews, looking at what valuation can be achieved, what funding is achievable, what the deal structure would look like, how much cash on day one, how much on deferred terms. We'll talk through retained equity and how that could work. We'll talk through what sort of stake the management team will need to put in. Really, the whole point of early stage advice, as I say, is to give clarity as to what can be achieved, not starting with something that's so ambitious that it can't be delivered. We'll try and beat, if we provide a valuation, we'll endeavour to beat it, and we might beat it by 5 or 10%, but our valuations tend to be fairly realistic. So with MBO feasibilities, if we can raise a bit more funding, providing it's on sensible terms that doesn't stretch the business too much, we'll aim to do that. But our feasibility reviews do tend to give a very accurate reflection as to what can be achieved. And on the basis of that advice, it gives you the information to decide whether now is the time to move forward with a transaction or whether there's work to be done first. Once the client decides to move forward, we get into our lead deal advisory services, where we're leading the process from start to finish. And as Greg's talked through the different processes depending on the different types of transaction, but we work very closely with our clients and management. If it's a management buyout, we work very closely with the solicitors acting on the transaction and the external accountants and the tax advisors. It's got to be a team effort, everybody pulling the same way, working well together, and we're very experienced in doing that. We put here dealing with issues as they arise. We prefer to deal with issues before they arise, so spot issues that could cause problems and deal with them before they become major issues and before people get boxed into corners. So deal with issues before they arise, ideally. And ultimately, delivering the deal, making the deal happen, as we say on this slide, not making the deal happen at any cost, making the deal happen where it's right for our client. And usually, or always, I think it's fair to say, right for the business as well. So that's a very quick description of how we can help, and we'd love to talk to you on an individual basis about how we can help with your businesses. And Catherine will be emailing out in the next day or two an opportunity for you to respond and say, yeah, let's have a video call or a meeting just to discuss your own businesses in more detail and how we might be able to help. And we don't mind if you're thinking about a transaction 3 or 4 years away, or whether it's a transaction you want to embark on immediately. Happy to talk, whether it's now or sometime in the transactions many years in the future. So this stage, Catherine's going to come on and host the Q&A session. I think we've had at least 3 or possibly 4 questions. Catherine, do you want to go through those questions?
Yes. Yeah, can you see me? There we go. Yeah, sorry, another one had just popped up then, just as you were teeing off the Q&A, Andrew. Hello, everyone. Right, the first question we've had is around deferred consideration, and it's what sort of interest rate would be reasonable for deferred consideration in an MBO?
I think it's a good question. We often see the norm over the last few years, the norm has been nil, and I'll come on to explain why the norm is nil. But equally, you can justify an interest rate of 9, 10, 11, possibly 12% because the money is owed by a fairly small company that's just gone through a transaction where they've taken on more debt. So if you look at the risk profile of the deferred consideration, I don't think HMRC would have any issue with 9, 10, 11, 12% as being an interest rate, that's a commercial interest rate given the risk profile of the deferred consideration. Having said that, in nearly all cases, clients choose to charge an interest rate of nil. And they do that really for two reasons. One is clients would prefer to have a larger lump sum and agree a lump sum on the basis they're not going to charge interest on the deferred, because the lump sum, the capital sum is taxed at lower tax rates than interest. So often clients, may push the valuation a bit higher. There's no interest calculation in it, push it a bit higher and decide the quid pro quo is not to charge interest on it. And the second reason is interest at high interest rates stretches the business at a time when it's trying to pay off bank debt and other debt and service other debt. Is quite helpful for the deferred consideration not to have any interest on it. The sort of halfway house is to start with no interest on the deferred consideration, often for, say, the first 3 years, and then step in with maybe 8, 9, 10, 11% interest rate from the start of year forwards, because that then creates the commercial incentive. It then makes the deferred consideration the most expensive funding from the start of the fourth year. So it creates the commercial incentive for the management team to refinance and pay off the deferred consideration early. So the simple question, more complex answer, but it really depends on the circumstances. That's something we would advise on at the time.
That's great. Thanks, Andrew. The next question's in two parts. I'll split it into two to make it a bit clearer. So in an MBO situation, if you've got cash reserves, can these be withdrawn at the time of sale completion?
Greg, do you want to take that one?
Yes, and the answer is that yes, they can be extracted as part of the deal. So normally when we talk about company valuations, we talk about valuations on a cash and debt-free basis, and any sort of surplus cash on a company's balance sheets that isn't required to for the business to operate with or to pay corporation tax liabilities would get added to that valuation. And in a management buyout situation, those sort of surplus cash reserves would be lent to the company, the new holding company that's set up to carry out the management buyout, and then that cash would be paid out to the sellers of the business as part of the deal.
Great, thanks, Greg. And then the second part of the question, again, in an MBO situation, what's the average percentage of the sale price that you could expect to receive? I think that's on completion. And how much would be deferred and for how long?
I think it really does depend on the circumstances, but generally speaking, you might find that perhaps half of the deal value can be paid out in cash on day one in a management buyout, and then perhaps the other half would be paid on deferred terms. But that's it really does depend. I mean, we've advised on deals over the years where there's been a relatively small amount of cash paid out on day one, and virtually all of the deal value paid on deferred terms over a number of years. Or it could be a business where it's much easier to borrow money from banks, and there's one deal I can think of a couple of years ago where we were able to make use of an invoice discounting facility within a company that meant that all but probably 70 or 80% of the deal value could be paid out in cash on day one with a much more modest sort of level of deferred consideration. So it depends on the nature of the business, the assets on the balance sheets, and what the price for the company is. But generally speaking, you might expect half of the deal value is paid out in cash on day one.
Thanks, Greg. One last question then for you both. Is Entrepreneurs Relief available for both a company sale and for an MBO?
Yes, yes. It's not called Entrepreneurs Relief anymore. It's for some reason, the Chancellor decided to change its name to Business Asset Disposal Relief, which is more of a mouthful, less catchy name, but everybody still calls it Entrepreneurs Relief. And the lifetime limits were dropped just over 2 years ago from £10 million lifetime limits to a £1 million lifetime limit. But for business owners selling the shares who qualify, and nearly all our clients qualify, there's very few that don't. The ones that don't tend to be people who've retired from the business, they're not employed anymore, and they're not a director anymore, so they might not qualify. But most of our clients qualify and pay a 10% tax cost on the first £1 million of gain and 20% above that. But yes, it's equally available on management buyouts and trade sales.
Okay, great. That's all the questions. Thank you.
Brilliant. Well, thank you very much. As I say, Catherine will be in touch. She will email out the slides. We have recorded this webinar. That doesn't reveal any confidential information about participants at all. It's just the presenters are shown on the recording. The recording will be put on YouTube later today. Catherine will send the link if you need it. So if you missed part of the webinar, if you joined late or got distracted and couldn't watch it all, please use the YouTube video to catch up, and would welcome the opportunity to talk to anybody listening about their own businesses. We've been talking in general terms today, but to talk specifically about your businesses and how we might be able to help on a no cost, no obligation basis. So at this point, we'll bring it to an end. Thank you for listening.
Thank you.